So, hi guys, good evening, good day, good morning, wherever you're watching from. So, today I'll be teaching you guys a top down analysis, what you should do starting from the daily time frame. This is the daily time frame. I will be showing you the confluences you need to look out in the market to know what to do before you take your trades, either for a buy or for a sell. So, this on the daily time frame, you can't take your trades on the daily time frame because it's going to take years before it plays out. So we're breaking it down. That's why we're breaking it down from the daily time frame to 4 hours, 1 hour, and 15 minutes. Because if you execute our trade on the daily time frame, finding out the confluences you need, the order block, the breaker block, the change of character, the breakup structure, all those things we need before we take our trade. If you look for it on the daily time frame and execute it on daily time frame, it's going to take years or months before it plays out. So that's why we are breaking it down from daily to 4 hours, 1 hour to 15 minutes. So join me as we get started. So firstly, on the daily time frame, I'm going to mark out the demand zone and the supply zone. So here is the demand zone. We are going to map out the demand zone. So this is the demand zone. All these past data are gone. So we just start from here. We don't need those information anymore. We need the recent information. So from there is the demand zone. Yeah. We, we can also call it the supply, the support. The demand zone can also be called the support zone, using support and resistance. But there is the supply zone, which can also be called the resistance level, using support and resistance. So we'll map out first the demand and the supply zone, which we are going to be focusing on. So just map it out, demand and supply. It can also be called the support and the resistance. It can also be called the support and resistance. This was the support and resistance indicator I used when I was a beginner. You can see the red side is this resistance, the blue side is this support. But I no longer use this indicator because that was when I was a beginner. So first you manually map out the demand and the supply zone. So looking at this chart, this market is the bullish chart. In the bullish market, you can see this is a bullish market. Losing closer, there's a first value gap from that supply zone and an order block. And the first value gap, that is an imbalance before the order block. You see, the order block is a negative candle before the positive candle before it caused the market to go to the opposite direction. That's an order block. So the order blocks that cause the market to change character going down to the opposite direction, and the fair value gap that occurred when that change of character is happening. So look at that fair value gap, the imbalance there. Look at the imbalance there. You look for the fair value gap and the order block. Then you look for the fair value gap and an order block. Look at it. That's the fair value gap from that supply zone. And look at this now. There's the previous low. There's a previous low. There's a previous low, and the market swept that low. That's what they call sweep of liquidity. But if this market was in a smaller time frame, this is what we are going to be doing. You put the SL above the previous high, targeting the recent low. Your SL is as important as your trade. Your SL is as important as your trade. So we target the above the previous high as our SL and target the recent low as our TP. This is for a sell. So after we find out the order block and the imbalance, you see the previous low, the market cleared it like this. The market cleared that low and swept and went up. That's why we call it sweep of liquidity. So let's go and look for this kind of diagram on a smaller time frame. So when you execute it on a smaller time frame, you get to understand. And we won't wait for too long before the market will begin to play out. This is going to take years before the market plays out. So we just need to go down to a smaller time frame, like the 4 hours and the rest. So we are going to go to the 4 hours now. From the 4 hours is look at it from the 4 hours here. From the 4 hours, up now the support and resistance zone from the 4 hours. Look at it here. From the 4 hours, this is the demand zone from the 4 hours. This was the demand zone from the 4 hours. This is where the market is rejecting to the upside. You know, the market was a bullish, it rejected. There's a change of character coming down, making it bearish and begin to go bullish again. So that place where the market swept the previous low is called a liquidity sweep or a sweep of liquidity. You can see the market has swept that previous low. You write that place as your liquidity sweep or a sweep of liquidity, because if you are buying and your SL is below that, the market is going to clear you. You're going to hit your SL, then start going up. But meanwhile, you analyze the buy trade. But if your SL is within that range, it is going to clear you and begin to go up, and that how painful that can be in the market. So you just have to wait for a sweep of liquidity before you take your pending order, or you make that possible in your pending order while you're taking it, to be sure that if before the market will hit your SL, it will at least start going up your direction before it hits your SL. So that's it. You just wait for the market to create a liquidity sweep before you analyze your buy limit. So whenever the market is going like this direction, it happens both sides, either for a buy or for a sell. So let me show you what a liquidity is. I've done this video before in one of my videos, what a liquidity talks about. So this is what a liquidity looks like. Liquidity up, down, up, down, up, down. Liquidity is money. When the market is going up or down, the market is giving you money. So when the market is going up or down, the market is giving you money. So that's liquidity literally. Then when the market clears the previous low or clears the previous high, it's called the liquidity sweep. So that's what it's all about. When the market clears the previous low or clears the previous high, it's called the liquidity sweep. The movement of up and down of the market is called liquidity. So this market like this is beginning to reject from the fair value gap. The fair value gap and the order block are the changing directions of the market. The market begins to change its direction from the fair value gap or from the order block. That is making the market to go to the opposite way of the market. So you need to respect these confluences, this order block and fair value gap. Those are the major ones that actually control, are the major ones that you actually look out for when you want to take up your trades. So you see the order block there. That is the order block. the next action is the fair value gap. The fair value gap can be one candle, it can be two, it can be three, it can be tiny candles, but it's mostly always a long negative candle or a long positive candle. So we're still going to analyze the market and how we're going to take trade on this market. So remember, that's the other block there. That's the other block, and you have marked out the other block. This other block caused the market to go down to this direction. The market caused the other block caused the market to go down to this direction. Then you see, look at it. This is the liquidity sweep that I told you. It cleared the previous low. It cleared the previous low. This is liquidity sweep. Clear the previous low. Then it's now going back to, if you're on this trade and you not place your SL very well, it's going to tap you out of your SL, then start going to your direction. So you need to be very careful. So what we are going to do now, we wait for the market to come back to our supply zone and hit it perfectly before we sell. So, but this is the first time frame. We'll go to 1 hour and see what we can do with the 1 hour time frame and see. Look at it. Market is actually getting bullish on this low now. Look at it. You know, from the beginning of this chart, the market was bullish, changed character to sell, bearish, and now it's changing again to being bullish. Changing of character is the changing direction of the market. When the market is changing direction, what do you mean by change of character? So you can see now on this 1 hour time frame. Let's go to 1 hour time frame. You can see on the 1 hour time frame, you can see this market is bullish. You see, it started from bullish, bearish, and bullish. So for you to have more details, you just need to keep going to smaller time frames for you to have more details. You just need to keep going to smaller time frame. Let me clear this so we don't get confused. This is the other block. I will map out the other block that caused the market to cause a break of structure. There is the market that is this other block that causes market to break the high. That's the break of structure. That other block that caused the market to either change direction or break of structure. That is the other block we're looking at. Whenever in whichever chart, whether a negative chart or a positive chart, whether bullish or bearish. So I'm going to do the other block that will cause the market to change direction and start going up. So if the market is rejecting, this is another other block that caused the market to break structure. You see, another other block that caused the market to break structure. So, but if the market is coming down, the market will first of all respect the first order block. Respect the first order block, go up a little, then come down to respect the other block. If that one can hold it, it will come down to respect. If this can hold it, it will go up and come down to respect the older order block. Higher time frame order blocks are always valid than lower time frame order blocks. Higher time frame order blocks are always valid than lower time frame order blocks. So if that one smaller time frame order block can hold it, it will come down to respect the older one, then sweep the liquidity, then go up. You see, that's what the market typically does. So this is actually the market reaction whenever it wants to buy. It's always a liquidity sweep that is giving me that confidence whenever I see a buy market. So I look out if the market has actually swept that liquidity. So I won't be among those the market is sweeping out from the trade. So that's typical. That is all I do. That's typically what I do. So wait, let me delete this and the trade. So now we have mapped out a new demand zone. Look at demand zone. We are going down into smaller time frame. Let's go down into smaller time frame. So now this is a new demand zone. We want a trade that when we take, it's not gonna we are not going to stay long on that trade and we'll take our profit. That's why we are going into smaller time frames. We don't want to stay long on the trade, so we'll just take our profit and go. So there's a law that says that whenever the market taps into a zone, either supply or demand zone, if it taps more than two times, that zone is becoming weak. On the third one, the zone may break. You understand? On the third one, the zone may break. So whenever it taps like this more than two times, the market is typically becoming weak. The third one, the zone may break. Yes. So the participants of these markets are either the buyers or the sellers. Those are the major participants of the market. It's either you are buying or you are selling. Nothing else you are doing in this forex market, just to buy and sell. So when it breaks like that, whenever a zone is broken, that means the opposite direction of that zone has won that trade. If the opposite direction of the sellers on this chart now have taken the trades and the chart goes below the zone, that means the sellers have won. So you just need to follow the trend because you're a retail trader. So this is it now. As we have mapped out our supply, our demand zone, our recent demand zone, let's go down to the 15 minutes time frame. Let's go down to the 15 minutes time frame. You can see this is a new demand zone. This is a new demand zone. We'll look for a new break of structure. There is a new break of structure. Look at it there. It's a break of structure. So BS. You can see this fair value gap here. Yes, the fair value gap is always the directional point, the opposite directional point of the market. That's the fair value gap. The fair value longer than that, but that's the fair value gap. That's where it started from. So the fair value gap is the opposite directional turning point of the market. The fair value gap is the opposite directional turning point of the market. The other blocks are the opposite directional makers of the market because these are the places where the market makers take their trade. Institutional banks take their trades. The other block and that fair value gap, which causes an imbalance. So I'm mapping out the supply zone on the 15 minutes time frame. This is it now. The market is showing bullish on this chart. You can see because it has not swept that previous low. We are still expecting the market to come to that axis and go up. You understand? We're expecting the market to come to that axis and go up. So let's leave it now. So if the market do not respect that axis, if the market do not respect that axis and it comes down to this point, if market do not respect that axis and it comes down to this point, we are always waiting for a sweep of liquidity. We're always looking for a sweep of liquidity. Why? Because the older order blocks are always valid more than the newer order blocks. The older time frame order blocks are always valid more than the newer time frame order block. So if I'm to use this chart, I'll use the old one to hold my trade. I'll use this old one to hold my trade because if I put my SL on the old order block, my SL is going to be very long. So but the old high order block, taking your trade from there, your SL will be very short. So I'll wait for the market to come down and tap me in, then go up. You see, I can't use the new one because the new one, if I should put my SL in that range, the SL will be very long. When a liquidity sweep occurs, it's going to sweep me out of the market. So that's why I'm putting my SL above or below the order block. So you can see, go up like this, clear, come down, tap me in, then go up. That's what I'm looking at. Yes, sir. That's all I'm looking at. At least for the first 15 minutes, I should be able to catch that trade and make my profit before I go out. So now that the market is at this range, let me take it again. Goes up, come down, come, come down. You see, we're just expecting the market to reach down, come down like this. So it comes here, like maybe it comes to this point, come like this, tap me in, boom, boom. And if he doesn't clear, if he wants, even if he wants to create an inducement or sweep of liquidity, it's not going to hit my SL. It's just going to be in the middle of my SL. It's going to range in the middle of my SL, hit my TP before it starts going down again. That's a change of character, or he goes up. My SL is now holding the funds for liquidity sweep. You understand? So that's all that happens. SL is now holding the funds for liquidity sweep. So this this is just it. This is not your father's house. You just have to analyze and wait for the market to play out. You understand? So the other blocks and the fair value gaps are confluences that the market respects. Look out for break of structure. Look out for change of character to know if the market is going to change character and go to the other side, or break structure and go to the other side. So most times I check this news to see the updates of the market and know if the market is the news and things to know about the market, and know if the market is either, most of the commentators on these charts tell us more of what to do in the market. So the other part of it are ideas. You can see news, ideas. These are though these individual ideas made by people just like you and I, and those are individual ideas. But that news is what TradingView is giving to you. So TradingView is telling you about the news and everything. And that dollar sign, that US dollar flag sign, is like when the news is coming up again. You see, today's 13, the next time of news is 14th. That news is telling you the previous price action, the recent one, and the actual one. So it's telling you the previous, the forecast, and the actual. That is, the forecast is, it is forecasting. The previous, it is telling you the action of it previously, and the actual one. So these are the news that you look out for as well. Read them to know what the market is saying. So like I said, there must be a break of structure to the up direction like this. There must be a break of structure to the upside direction. Look at it here. A break of structure to the upside direction. Then an inducement which will come to sweep the other block before it goes up. You see the break of structure, other block, break of structure, an inducement that will come to sweep the other block before it goes up. So that's it. Same for the sell as well. I wish I can turn this upside down. Double tap of it, other block, inducement, and everything that will cause you a break of, it will cause the market to tap you into your buy limit, and that's it. Boom. Your SL should be below your order block. Do not forget that. Your SL should be below your order block. Do not forget that. So even if I want to take a sell on this trade, I'll take my sell from the supply zone and make my SL above it, make wanting the market to tap me on that supply zone, then go down. That is if the market is bearish. But this one now, the market is bullish. I can't take a sell for a bullish trend. This is a bullish trend. It has not created a new low. It's still working on the old lows. You understand? It has not created a new low. It's still working on the old low. But if it's for a sell, this is what you should look out for. And you put your SL above the supply zone so you don't get kicked out easily. And a sell trade is when the market is selling, not when the market is bullish. So you just have to be very sensitive. So and you touch your SL so that your SL doesn't hit. That's it for a sell and for a bearish market structure. So for a bullish market structure, you buy. That's the reason why you buy for a bullish market structure. For a selling market structure, for a bearish market structure, you sell. If this market has created a recent low, I would have analyzed for a sell, but the old low is still valid. It has not created an old low, so we're anticipating for it to come down and tap us up and buy. Because definitely, if it gets to that supply zone, it will clear the supply zone and go up. It's still going up. That's what we are talking of. Just know when the market is going up for the direction. Look out for the break of structure. Look out for the other blocks, fair value gap, and wait for it to retest on that zone. Then buy if it's a bearish market. If it's a supply, if it's a if it's a bullish market, if it's a bearish market, wait for it to tap you on that other block for the bearish market, then you sell. Just firstly, know the direction of the market. That's first thing first. Know the direction of the market. That is very important. You sell when the market is bearish, you buy when the market is bullish. So the retesting is just to know when it touches those other blocks, those conventional centers, the break of structure and the fair value gap. Thank you and God bless you. Bye for now.